Yeah, let's start. So today we are starting, like we have already discussed about these securities. There are two types of securities. That is like one is in the form of debt. These are the ways these are the ways in which the companies arrange funds for them. So like first one we have discussed about the debt, and then we also know that we have the companies can arrange funds in the form of equity. And like here we have also seen three categories: trading, and like first one I'll say held to maturity. This comes under held to maturity, this won't come, but in the case of available for sale and trading securities, both debt and equity securities come. Okay, so now today we are going to discuss solely about the equity securities because we have already finished the topic related to debt securities. So let's start with equity securities. Okay, so investment in equity securities represent ownership of capital stock. That means if you buy the shares of some company, you become the owner of that company to the extent of investment whatever you have done in that company. Okay. Now here what does cost mean? Cost includes price of the security, that means price of the stock which you have bought or purchased, plus brokers commission and fees related to purchase. See, whenever you invest in a stock, so for example you take SBI stock, or you take Apple stock. So it is not only the stock what you buy, stock price. That is what, this is not the only price you're going to pay for this. Apart from this, you're going to pay the commission, that is broker's commission, because he is selling the stock to you, and he would charge commission for that and as well as his fees. Okay. Now, so degree to which one corporation, that is investor, acquires an interest in common stock of another corporation, that is investee, generally determines the accounting treatment for the investment subsequent to acquisition. Yes, so it depends how much stakes the investor has taken in the investee. Based upon that, the accounting treatment would come into picture, that is related to that particular investment subsequent to acquisition, that is after acquisition. So now there are three categories here in which we will see how the acquisition of equity securities happen, and how that means how much stakes the investor takes in the investee, and based upon that we decide what kind of accounting treatment should be given to that kind of acquisition or that much stakes what investor has invested or like bought in the investee. So let's see here. So I would once explain you something. See, if the investment is less than 20%, it is considered as general investment. If the investment is more than 20% but less than 50%, then so here we will show the stocks at fair value in the balance sheet. You can see here investment valued using fair value method, and it is like less than 20%. That means between 0 and 20%. Here there is no significant influence. In this case, less than 20%. That is in case of generalized investment I'm speaking about. Fair value method, that means you will be showing at the fair value, you will be showing the securities at their fair value in the balance sheet, and here no significant influence. No significant influence usually exists. Okay, that is what. So what do you mean by significant influence? Significant influence is something like the investor has some kind of influence over the investee. With influence, what we mean here is investor like kind of like is a like when investor, that is company A, has more than 20% stakes in company B, then what we can say here is, or infer here is, this is nothing but these two are associates or affiliates. And here we see significant influence of A in B. What do you mean by significant influence here? The significant influence here means A has good amount of stakes in company B. A is involved in policy making. That means A is involved in policy making, related to certain prime or important projects along with B. A is always like A's directors can represent in B's board, and as well as technical know-how also A can share with them, or A can get some technical assistance with them with B also. Okay, so this is nothing but they work in a very they work in collaboration. But when it is like when A has less than 20% stakes in B, then all this points which I have mentioned regarding significant influence is not existing in B. Okay, that's what. So here significant influence exists, and equity method is what we follow here. Equity method. Equity method is very simple. That means whatever the profits the company B earns, out of that A should get how much they have the stakes in B. For example, if A has 30% stakes in B, so A should get 30% of the profits directly from B. Okay. Here, like A cannot demand anything from B. That means the market value of A stocks as on that day is what at which they will be kind of recording in the balance sheet. For example, A has 10% stakes in company B. So whatever the market value of the securities as on that day, what he sees is what at which he would be recording in the balance sheet. But here A would be recording the securities at what we say, they will be following equity method. So they would be seeing what is the cost of the equity as on today, and they'll be adding whatever the profits they got, whatever they have got from their investment in company B. That means their share of profits also, whatever they have got, they will be adding that to this particular investment value. With this, the investment value grows. Okay, we are going to see that here in the accounting, like within some time. And if that means I am explaining you this is the cost of this security or investment, and plus the share of profits what A got from their investment in B. Now, if the investment is done beyond 50%, then comes then like A and B. We have these two companies. A is the investor and B is the investee. A has invested in B and bought more than 50% stakes in company B. That means A is a parent of B and B is the subsidiary of A. Okay, so here what happens? They do consolidation at the end of the year. That means they show themselves as like they prepare group accounts and they show themselves as one company. Now, so here you can see in consolidation what happens. I would like to explain you in consolidation some important points. See, like when A company and B company, these two are different companies, then they prepare different set of books. But now when A has this was point number two, point number one. Now point number two is A and B. These are two companies. A has more than 50% stakes in B company. Let's say 70% stakes. So A is the parent and B is the subsidiary, and they make group accounts at the end of the year. So they show themselves as AB company now. When they were like separate companies, or till the time they don't consolidate at the end of the year, they maintain separate set of books. Okay, so when they maintain separate set of books, things are normal. But when they show themselves as one company, then some particular intercompany transactions. Here very important points I'm explaining. Intercompany transactions are to be eliminated. Just a second. Yeah. So intercompany transactions have to be eliminated. Now, why intercompany transactions have to be eliminated? This is a person and he has he has two pockets. He has 100 rupees in this one pocket and he just puts this 100 rupees in this another pocket. Now, how much he has? He has 200 rupees or 100 rupees, Zarina?
200.
Zarina, I'm asking once again. This person had 100 rupees in this pocket. Okay, he has just taken out 100 rupees from this pocket and he has put that 100 rupees in this pocket. Now, how many rupees he has?
100.
Sorry?
Only 100. 100 rupees.
Only 100. The same thing comes into picture here. What happens is whatever the investment is done by A in B, okay, it doesn't create any excess amount in the company. That means the amount is the same in the company when they show themselves as one single company. That means it is like putting the money from one pocket to another pocket. Okay, suppose I have a shop in one area, that is Secunderabad, and one more area in Hyderabad. So these two are twin cities. So shop A and shop B, I have sent some 50,000 rupees from shop A to shop B. So do you think when I'll be making an account at the end of the year, I'll be showing these two shops as one shop? Do you think any excess amount this B got? It is the same amount what they have in the company, correct?
Yes, sir.
There's no increment because it is nothing but money from here to there has been just transferred. And at the end of the year, when they show separate set of books, it's a different case. When they show themselves as one company, it is nothing but they have that much cash what has gone from this pocket to this pocket. That is, it's an exchange of money from pocket to pocket, but no increment of money. So what happens is intercompany transactions have to be cancelled, I said. So if A has sold goods to B on credit, so A have receivables from B and B have payables to A. So we will cancel this receivables and payables in the balance sheet. Why? Because if goods have been sent from A to B, okay, and A is supposed to make payment from and B is supposed to make payment to A. So when you show them as one single company, it seems that nothing has been transferred from this company to this company. Why? Because the goods are still in the same company, that is in the AB company. Correct or wrong? Hello?
Yes, sir. Yes.
Yeah, maybe transfers have happened, but the reality is the goods are with them. That's it.
Yes.
So we will cancel the receivables and payables, and as well as we'll cancel the share capital. I'll just write on the accounting treatment here. So this is the balance sheet of company A, which is the parent, and this is the balance sheet of company B, which is the subsidiary. And company A had a cash of 5 lakhs. And what company A has done is they have invested in company B. And the investment they did of 2 lakhs. So the journal entry for investment is investment to cash. That is investment in company B. Investment in B to cash. So they invested 2 lakh rupees. And for company, so what has happened is 2 lakh we will subtract from 5 lakhs. And now we have how much cash? We have 3 lakhs of cash. This is I'm writing in circle. And we have investments of 2 lakhs. Okay. And here the entry for company B would be cash to capital. Cash to A's capital, 2 lakhs, 2 lakhs. So capital we will show here as 2 lakhs and cash we would show here as 2 lakhs. Okay. Any doubts here?
No, sir, it's clear.
Asset, liability, and here also liability and asset. This is T-shape I'm showing. Now what would happen when these two are two separate companies? There is no issue. But when we show them as one single company, then what? Then it is understood that nothing has gone from A to B. If some amount comes from outsiders except A, then that we can consider that money that B has got some excess money, or this particular group A, that is group is nothing but AB company. This group has got some excess money, but it is between the A and B the things are happening. So it is of non-commercial. This kind of transactions are called non-commercial nature transactions. Okay, the transactions of non-commercial nature. So now what we would do is we would like cancel the capital and investment. We will cancel this investment. Okay, and the share capital of A is 10 lakhs, for example. We'll cancel this investment and this capital. Okay, so now what is that when we consolidate? How much cash we have, Zarina? 3 plus 2 is how much?
5 lakhs, 5 lakhs only.
5 lakhs. So do you think anything like B got excess? No. The group has how much cash now? Same 5 lakhs, correct or wrong?
Yes, sir.
Yeah, and this capital of B has nothing to do here. When B maintains separate set of books, that's a different case. But now here it is AB company. So the capital is already of A here. That was the only capital which was in existence since beginning. Just some cash A has given to B, and that the journal entries when they maintain separate set of books, they show in this way. But when they consolidate, the reality is that B has not got anything from A. The money is in this AB company itself. So 5 lakh cash they have. OK, so when you consolidate, now the consolidation is nothing but you have cancelled investment and capital that has gone. Now we will make a consolidated statement of AB company, whereby we will show cash of 5 lakhs and capital of 10 lakhs. OK, and nothing else. OK, this is the treatment. Now accounting subsequent to acquisition. So market price available, market price unavailable. See, if market price is available, you will be showing at market price. And this is I'm speaking about holdings less than 20%. That means I'm speaking about general investment. OK, if market price for stocks is available, you will always show the stocks at fair market value in the balance sheet. So value and report the investment using the fair value method. But if market price is not available, so you will be showing the investment at cost. That means how much you paid for acquiring those stocks. OK, now securities are reported at stock. Securities are reported at cost, and then dividends are recognized when received, and gains or losses only recognized on sale of securities. That means when you invest in a company, if you don't have a market value for that stock, then you will be showing that stock at cost, and whatever the at cost. If the market value is available, then you will be showing at market value. And one more thing, dividends are always recognized when the companies receive dividends on their investments. Correct? They are shown in the income statement as an income, investment income. And when you prepare cash flow statement, then you will be writing that in the cash flow from investing activities. Understood fact when you receive dividends. And if the stocks are sold in the market, so any gain or loss on the stock is again recognized in the income statement. OK, that is profit from the sale of securities. Now holdings of less than 20% category, holdings less than 20%. We have two categories of stock here, Zarina. One is available for sale, one is trading. You know the intention behind available for sale is you want to hold it for some period of time, then you want to sell it. And trading, you are ready to sell if you get a customer immediately. And you always show the available for sale securities at fair value and trading also at fair value. That means that is the value at which you'll be showing in the balance sheet. And the like, as you know, you want to hold it for some period of time and then want to sell it. So whatever the holding gains you got, you'll be showing in the OCI section. Here you'll be showing in the P&L, and dividends in the P&L. And if you got profit on sale of asset in the P&L, here also the same treatment, P&L. Okay. Once have a look through this. And as you know, equity securities have no maturity date, and a held for sale category is not there in case of equity securities. Only for debts we have that.
Done, sir.
Finished? Hello?
Yes. Hello, yes, sir.
Yeah. You have some work, Zarina? Hello?
No, sir.
Okay,
No.
I'm continuing. Yeah. So let us see a question here. Loxley Company has the following portfolio of securities at September 30, 2007. Its last reporting date. You can just read this question. See, Loxley Company has already some portfolio of securities, it seems, on this date. And the securities are in the form of trading securities. So Dan Fogelberg Inc. common shares, they have the cost of those shares are this. That means they bought at this. It seems, and the market value is this. You can see there's a fall. And the Petra Inc. preferred stock, they bought these many shares. The cost was this and the fair value is this. And they bought common shares of Tin Weisenberg company, and the cost was this and the fair value is this. And except the Petra Inc., nothing has increased, it seems. On October 10, the Fogelberg shares were sold at a price of 54 per share. So they sold this shares, it seems, 54. And so 5,000 shares they sold for 54. We'll see. Because we have to give accounting treatments for everything. In addition, 3,000 shares of Los Tigres were acquired. So when they sold Fogelberg shares and they acquired Los Tigres stock, okay, at 59.50 per share on November 2, 2007. The 31st December 2007 fair values were Petra, Los Tigres and Weisenberg. The fair market values are given. Just have a look to this, Zarina. I'll be back in a second. I'll have some water and come.
हाँ सर जी प्रणाम। हाँ सर जी। आप आ रहे हैं क्या? अच्छा अच्छा, हाँ हाँ ठीक है, मैं भिजवाता हूँ। ठीक है सर, भिजवा रहा हूँ, अभी भिजवा रहा हूँ।
Okay, have you read this? Let's start. Now, see, we have seen all the chain of events here. Let's see. They're asking you to prepare journal entries to record the sale, purchase, and adjusting entries relating to the trading securities in the last quarter of 2007. So Dan Fogelberg, Petra and Tim Wenzelberg shares are given the cost and fair values. We can see that the value has like the value of these like in totality have decreased, it seems. Correct. So these were of this much and now these are this much. So fair value adjustment we can see of 19,000. Correct. Now.
Yes, sir.
Yeah. Now we will see individually. We will take Fogelberg and we sold it for 2,70,000. It was of how much cost? 225. We sold it for 270 and we got gain on sale. So we will record this in P&L. Cash comes in the cash account. Securities are gone now. No investments are there. And then again, we also, it seems, we sold, like we acquired, okay, we bought the investments in the Los Tigres of at 59.50 and 3,000 shares we bought. So this much by like this much to cash. This is the journal entry. So trading securities to cash, we bought this much worth of shares. And then now we would see the Petra Inc. Preferred stock, Tim Winsenberg and Los Tigres. This is the cost because they have given the latest new costs, it seems. Petra, Los Tigres and Winsenberg. And then again, this is what is the fair value. So they have given the fair values. So like what we have, Winsenberg, Petra, Fogelberg, we have sold, it seems. Los Tigres, this has come into picture now because we have shown here that we have bought it for 59.50. That is the cost we incurred. So we have shown the cost of each and everything now and the fair values, and we see that there is a loss here, there's a gain, and there's a loss here. So net is this, and again the previous adjustment of 19,000. So this is the total fair value adjustment which has happened. 70,500 minus 19,000 is plus 19,000. So 70,500 minus of minus becomes plus, so it is 51,500 is the fair value adjustment, and it's a loss. So debit all expenses to fair value adjustment account. That means nothing but we can write securities account here, because when the value falls, we write the securities in the credit side. Okay, in the credit of the journal entry. So till here everything is all right, Zarina? Any doubts?
No, sir, it's clear.
Yeah. Now holding of less than 20, how would the entries change if the securities were classified as available for sale? See, only OCI comes into picture. So the entries would be the same, except that the unrealized holding gain or loss equity account is used instead of the income. That means instead of showing that any kind of gain in the SOPL, will be writing in the OCI section, SOPL and OCI section. That is other comprehensive income section will be showing the holding gains. Okay, and the holding loss would be deducted from the equity section. So if any loss here, any gain or any loss in case of normal scenario, that is in the case of trading securities, we have shown in the P&L. But in the case of available for sale securities, the intention is clear that we want to hold it for some bit of time and then we want to sell it. So any gain will be showing in the OCI, any loss will be showing in the OCI, deducting from the equity account. And now comes the holdings between 20% and 50%, as I've clearly explained you about the significant influence, and we will be using equity method. Let's see what is happening. So equity method record the investment at cost, and then whatever the profits or earnings you get from your investment, you add to the investment value, and dividends you show in the SOPL section. Okay, please read this question. Excuse me. So there we are. Equity method we are using. We are kind of we are following. We are like kind of using equity method for these kind of scenario, whereby the holdings are between 20% and 50%. So Pennington Corporation purchased 30% of the common shares of Edwards Company for 1,80,000. During the year, Edwards earned net income of 80,000 and paid dividends of 20,000. So this is what the information is. And here with this, we can understand that the investment is between 20% and 50%. So that falls in the category of associate. Can we say like Edwards is affiliate or associate of Pennington? Yes. Investment to cash is the first entry. The income is somewhere around 80,000 of Edwards, but Pennington would get only 30% of that as per the equity. They have that much of equity, so they are eligible to get that much of what we say share of profits. So 80,000, 30% is 24,000. And so the investment will grow by how much, Zarina? 24,000, correct or wrong? Hello.
Yes, sir.
Actually,
Dividend means, like
dividends, yeah, dividends. Actually, these guys like are supposed to get the profits. Okay, Edwards earn net income and paid dividends also, it seems. So on dividends also they are going to get 30%, correct?
yes, sir.
That's going to come in the P&L account. That's it. That means dividend is a cash income, na? So 6,000. See, what happens is your investment is growing by. See, your asset account is growing by 30,000. Correct or wrong?
Yes, sir.
That is 24,000 and 6,000. But investment are only growing by 24 and cash account is growing by 6,000 because dividend comes in the cash account. Correct?
Yes, sir.
And like cash to investment. That's it. So this is the entry. And if I'm not wrong, this particular information regarding holdings of more than 50% I have explained. It's a parent subsidiary relationship which comes into picture, and I've also explained you about the intercompany transactions. You have to cancel out share capital and investment, receivables and payables. All these things you have to cancel, and you don't have this in details. Let me be very clear. So we would not go into details of this. Okay. Just a second. And securities like trading securities, you should, which you are showing at fair value, is like as current assets. Why? Because you will immediately like to sell this if you get a good customer, and available for sale and held to maturity are non-current assets. Correct, Zarina?
Yes, sir.
Yeah. So this is the end of the chapter, and disclosures also you need to give. Generally, just a second, we will see like if anything is left over. If it is there, then we will cover up. Otherwise, if nothing, if it's not in the syllabus, we should not. So we have, okay, we have done this chapter 93. So we have covered up everything in this. Okay, this we have discussed. It's a general investment, and we have discussed like trading securities are shown always in the income statement, that is fair value through income statement. And available for sale securities, the intention is to hold for some period of time and then sell. So whatever the holding gains we show in OCI, so it is called fair value through OCI or other comprehensive income. This is covered. These are all things covered. See, what happens as per the accounting standard, the investor company must reassess the classifications of its investments in debt securities for their continued appropriateness. For example, if company no longer has the ability to hold the debt securities to maturity, okay, it would not be appropriate to continue to classify them as held to maturity. Suppose you had an intention of holding the securities for some period of time and then selling it, but now you don't intend to do that. You want to sell it immediately. So you will be classifying them from available for sale to, you'll be reclassifying them from available for sale to which security, Zarina? Hello. Hello. Hello.
Hello. Yes, sir. Yes, sir.
Yeah, I'm saying that, for example, you had the security and the intention was to hold it for some period of time and then sell it. That means you want to hold it for 5 years and you wanted to sell it after that. But now the intention has changed after a few months. And now if you get a customer, immediately you want to sell it. So now from available for sale to, it will be reclassified as what?
Trading.
Trading, and the treatment accordingly should be given as per trading securities. This amortization of discount and premium is already discussed. I've already explained you discount and premium. The securities will be sold at discount and premium. That is done. Significant influence, fair values. I've already explained right now. Entries are covered. Gain or loss is done. That means if something is of 100 rupees, you bought for 100 rupees and you're selling it for 120. This is the cost and this is the fair value. 20 is the gain. We have discussed about this. Dividends we have discussed. And we have discussed about the equity method. We have discussed about the earnings, also the entries. Goodwill is nothing but like, for example, if A company is acquiring B company and the value is like 1 lakh and A is company 1 lakh, A is paying 1,20,000 to B company to acquire it. So 20,000 excess what A is paying to B is goodwill. Yeah, that's what. If anything was, see, suppose some security was of different category previously. They are saying when a fair value or cost method investment, fair value is for trading securities and cost method is like, if you don't have a fair value, you'll be showing at cost. Qualifies as an equity method. That means A company had 10% stakes in B company. So they used fair value method to show in the balance sheet. But now A company has recently acquired more 20% in B company. So the total stakes of A in B is 30%. Now the A company has to do the accounting treatment based on equity method now. Correct? So that is what they're saying. Consolidated I've already discussed with you right now. See, variable interest entity Model. A variable interest entity is a legal entity that is financially controlled by one or more entities. For example, this is company A. This is controlled by company Z and also controlled by company a company B, and also controlled by company C. That means they have some stakes in company A. And that means this A has no majority interest. The entity holding the majority of financial control is called the VIE's primary beneficiary. For example, if Z has 40%, they have the suppose they have 60%. Z has 60% in A, C has 20% in A, B has 20% in A. So Z is the primary beneficiary in A, correct? That's what. So definition of parent in consolidation includes the VIE primary beneficiary. So Z is always called as the primary beneficiary, and they are the Z is the parent of A because they have more than 50% stakes in A. Consolidation process I have explained already, eliminating intercompany receivables and payables. And suppose if A and B, these are two companies, A has sold some goods to B. That means A's sales are COGS of B. These two have to be cancelled when we consolidate them. That means when we show them a single company, that is AB company. Why? Because nothing has been sold to B and no cost has been incurred by B. Because the sales has not happened from third party and B has not purchased the goods from third party. It is nothing but putting goods from one locker to another locker. That's it. And if A company sells fixed assets to B, when they maintain separate set of books, they can show that as a sales and this can show it as a purchase. But when they show themselves as one company, then it is nothing but putting one like something from one locker to another locker. That's it. So that should also be cancelled. And this also I've explained you, the investment and share capital have to be cancelled. And one more question I would ask. If this is A, this is B. A has done some investment in B. Let's say 70% stakes of B is purchased by A. So 30% stakes are with whom? Non-controlling interest. So NCI are minority shareholders. They have minority shares or they have less stakes in company B. Okay. So A is called the parent and the 30% stakes which are held by some company or some investors are non-controlling interest. So what happens at the end of the year? Whatever the profits are earned by B, 70% of the profits would go to A and 30% would go to NCI, non-controlling interest. So everything right from profits to reserve to retained earnings, everything is shared between the parent, that is 70% stake would go to the parent and 30% stake would go to the NCI. That means profits, retained earnings, anything. They both will share based upon their investments or their holdings. This is the end of the chapter, Zarina. Tomorrow we will start. So I will just put it here. See, we have to like discuss the last part of this, if I'm not wrong, that is other comprehensive income section. So tomorrow I will wind up this part. So first chapter would be done. Integrated reporting is done. Cash flow is done. Receivables is done. We will start with inventory in the next class. Tomorrow we'll start with inventory. Investments done. PP done. Intangible assets done. Income tax is done. Leases done. Only this warranty liability and equity transactions are there too. And this revenue and income measurement. So this week you can expect the reporting thing to be finished. OK, budgeting is done. Then I'll go for the variance analysis. This one that would take like at least 5-6 like 1 week classes to finish this entire section. then only costing and theory is there. That's it. Okay, Zarina, then tomorrow we'll take the class. Okay. Hello.
Okay. Yes, sir.
Yeah. Thank you, Zarina.
Thank you.
Please go for this chapter. Do this chapter. Prepare this. Okay.
Yes.
Yeah. Thank you.